welcome to the Closing Beat, everybody. Happy Tuesday to you. How's it going out there? Hope everything's good. Welcome to our show. We are financial advisors here at Jazz Wealth, and our condolences to the Munger family as well as Berkshire Hathaway, losing Charlie Munger there. Made it to 99 years old. That's a good run. That's statistically a lot better than most, but hey, sorry to hear that. Sad to hear that, of course, and that is the breaking news of the day. But we are financial advisors, and we play checkers, not chess around here. Private fiduciary wealth managers there. And our ideal client, if you're curious, is someone who can take one hell of a nap that when you wake up, you feel like, oh my God, I'm late for the school bus, but it's Sunday and you're 42, so there's no school bus. It's our ideal client right there. Take a good nap. I love it. Hey, Wine and Wealth, last week we were off for Thanksgiving, but the week before we did a great one on some tax strategies going into year end that are, you know, beginner, intermediate, and then some advanced ones as well. This week we're going to be talking about your transactions, how to look through those in the dojo, because you may have over-contributed to your Roth IRA. Want to make sure we don't break those rules because the IRS cares if you don't fix it. They don't care if you do fix it. So we want to work with everybody to make sure they do fix it. All right, the S&P here, I'm going to try some stuff today, right? We're going to try to save you a little bit of money because I recognize a trend out there with the questions I'm getting. But if we look at the S&P, more of the same, you know, post-Turkey Day, hangover, whatever it is, real calm and quiet. We know that the stock market likes to be kind of quiet in this week with a 0.19% average gain, and it's positive 55% of the time. So it normally is quiet, and that's totally acceptable there. Now, if we include today, I'm going to just zoom in a little bit. If we look at the high from 3 days ago, which today would be the high, and the low from today, look at this 3-day range. So in other words, draw a box from here to here. This 3-day range or spread between the high and the low is the smallest that we've seen in 4 years. You got to start that all the way back, Christmas Eve 2019, to actually find a range that is smaller today. Now, in the S&P today, a little bit different. So I would say a little bit stronger than yesterday, even though the performance is basically flat. You had about half of the stocks in the S&P were positive for the day. Remember, that was not the case yesterday. And we had twice as many names up 1%. It was still only like 64, 65 names, so not a lot, but still a lot better than yesterday. By the factor of 2. If we look at the NASDAQ here, up a little bit as well, but the numbers are bigger. That's all it really is. It's still a small range, tight, narrow range there for the NASDAQ. The Dow's going to say the same thing. It managed to get something going here this morning, but it lost all the steam just like everything else. And if we look at the Russell 2000, more volatile, I'll give you that, but still inside of a choppy range there. So it makes it a little bit more difficult. Looking around the sectors today, your real estate sector was just, it might have been tied for first place there. Let me see if I can pop this up here real quick. But real estate doing pretty good there, and that is consumer discretionary was your leader, squeaked it out at the end there. But real estate doing well thanks to interest rates. Anything in that category, they call them real estate sensitive sectors, they'd be like utilities and consumer staples and real estate. Well, they'll do better when we see this chart right here going up. All that is interest rates going down, price anyways there. So not too bad there. Oil finally getting a little bit of a bounce. Like I said yesterday, I don't know if that's the low. You have a very algorithmic looking downtrend here that is drawn almost a perfectly straight declining line from highs to lows in the middle of this downtrend. So I don't want to be the first to say that. And gold, we're actually going to start talking about that a little bit more because gold is approaching all-time highs. What are some of the things that you need to know when it comes to either having already owned gold or considering buying it, because every time gold gets on a tear, people want to buy it. I'll tell you one of them right now. You don't buy gold after it has a big run up. All right, gold goes in fits and spurts. See, this is the little bit of an off time here after a big run up. So it's very difficult to want to hop on the momentum of gold, at least in my little history here playing with the old market. All right. Going to save you a little bit of money. You ready? And then I'm going to teach you something. Okay. I'm getting a lot of questions out there from people going, Dustin, let's go into large caps. Let's get rid of small caps. Let's get rid of mid caps. Let's go into large cap. Or, hey, Dustin, in my 401k, 403B, 457, should I go into large caps there? They are clearly in the lead. I don't disagree with that there. And a lot of you want to ditch those to go to large cap. I will say probably not. Don't do that. We have an abnormally strong year so far, and so you're chasing momentum that has already given the momentum. It's already had the run up, and you're doing it. We want to buy on a more meaningful dip, a prolonged dip, not just a temporary dip there. A little bit tough. So what we're going to do, if you compare, we'll do it this way. If you compare small cap growth, mid cap growth, large cap growth, all together, you can clearly see the black line here. This is large cap growth with about a 24% gain. This is as of yesterday, so if you include today, it's going to have a 24% gain there. Year over year momentum. We want to know if that's meaningful. In other words, what we see this year, will it continue next year? And if so, will it be as fruitful as it was this year here? So we want to be careful. The other thing I want to look at, and we'll do this together, is mid cap. Well, let's do small cap, right? Small cap's had an off year. Is that because it's hinting at something bad? Or is it because it's actually discounted and maybe we should stick with it or go with it and, have some fun there? So we're going to use our research tool here. I'm going to actually just start. I'll use the large cap growth. We want to say, hey, greater than 20% gains in a year. It won't go back 30 years, but we'll do it that way. We want to see what tends to happen going forward here. All right. So actually, first thing I want to point out, there are only a limited number of years where we've had greater than a 20% gain. So if you decide to go all in on large caps, you're participating in something that doesn't often happen, right? So it's an abnormally large year. In other words, the ship is going. It's having a good time, right? Let's do a little bit of a look forward here. Now I want to know, I may have to do this again, actually. Let's see. Did I do it? Yeah, I got to go over here. Add that sucker back in there one more time here. I want to know if we have a year that's up greater than 20%, what does it look like going forward? And if it's good, or whatever it ends up being, hey, what's going on? I can't seem to load it up here for some reason. So I will reload the page. Maybe I got logged out. I want to know if it ends up being good, is it something that we have a pullback in the short term there? Or is it something that maybe just keeps going, and we can't mess with it? So maybe because I went 30 years there, let's see if I can pop this sucker in there and go over there. I don't know. Not working. So I don't know. I'll have to come back to that and actually share that with you there. I will point out, I looked this one up. I cheated. I looked this one up here earlier. Small caps. I'm a discount guy. I like when things don't have a great year because to me, it's like, is that an opportunity or is it a sign of weakness? If you look at small caps had about a 4% year. If we say any year where small caps had less than a 5% rally, what happened in the year going forward there? We actually find that in the years going forward, small caps will outperform large caps in the beginning part of that move. As you look towards a year out, of course, large caps can wiggle around and have this great time and whatever, but large caps tend to struggle after the year that they had a 20+% gain. Why do we want, now that's emotional, right? Think about this. It's an emotional thing because if you had $100,000 in your account, right? And 50 of it's in large cap and 50 of it's in other stuff. And you said, get rid of the other stuff. Let me go $100,000 in large cap growth. Now, large cap growth, we know in the first 6 months, it's going to start to pull back there, or at least, on average, it pulls back. Now we have $100,000 pulling back, whereas we previously would only had $50,000 pulling back. So it becomes emotional and you start getting yourself into this little back and forth because you've got a lot of money in something that's now falling, and the second it starts falling, and instead of losing $500, you lost $1,000. Instead of it falling, let's say it falls 10% and you would have had a $5,000 pullback, now you have a $10,000 pullback and you go, ooh, maybe I should get out. Meanwhile, what happens? Small caps, mid caps, they're like, hey, they always rally first. So they get going, and now you're pissed at yourself because of what you did. So be very careful. I'm getting that question a lot, so I want to bring it up. You know what I mean? It can be an emotional thing. Enjoy the ride with the large caps that you have, right? Maybe take some profits in the large caps and look to buy the discounted stuff. Don't sell the discounted stuff and go chasing the stuff that's already had a big move. It's almost a little bit frustrating. All right. Quick lesson here before we move on to stocks in the news. Do you follow the overseas markets there, do you? I want to point this out because this is something to point out now so that you go, yeah, it was like that. Why is it not like that this time? This is the China A shares. We call them onshore. They call it onshore and offshore China. If you ever hear somebody say offshore Chinese banks, real estate, whatever, traded down today. those are stocks that are traded in Hong Kong or they're listed here in the US, offshore from China. If you look at sort of mainland China, we call that onshore, right? So there's a difference between, so for example, if you're ever like, oh, I want to trade in China, A shares, you'd be thinking onshore. This is mainland China. If you use something like the FXI, actually, I don't know if this is going to be an accurate statement here, and someone's going to just give me, I believe the FXI is Chinese large cap. This would be considered offshore. A lot of these are going to be traded on a Hong Kong stock exchange, or like in the United States or London or something like that. So anyways, I wanted to point this out because this is fascinating. Do you guys remember when Evergrande, they're going bad over there in China? That's the property developers that are developing properties and condos and stuff, and there's nobody there, right? It's too much. They don't need it. Well, when they were at the beginning of, we may be going bankrupt, we're having financial issues, what happened in the U.S. markets, right? That was a big deal. It was all over the news. Oh my God, what are you going to do? This is crazy. China's going to fall apart. The U.S. is going to fall apart. I got news for you. It's even worse now. So over in China, the Chinese government is, and I just followed this, so I'm going to share a little international news with you. Chinese government is really, really concerned about the property markets. I've spent years helping Chinese investors over there, so a little bit more sort of nonsensical sort of information are wrapped around this. Their property markets are much more volatile than ours, by the way. So anyways, they're getting concerned about this. Not just Evergrande, they have their own problems at the moment that have gotten worse. So banks over in mainland China, onshore Chinese banks, are being forced to offer unsecured, low-interest loans to these developers. We're having some troubles. We need to get this bad debt off of our balance sheets and give it to somebody else. So the government says, you give them a loan, unsecured loan there, we want you to do that. That takes the bad debt that was on the developers, puts it on a bank's balance sheet, which, by the way, those banks are too small. They can't handle that kind of debt should it become, a defaulted debt. It's going to be an issue there. And so Chinese onshore banks trading at a big discount right now. It's tough to invest in that, but I'm not pointing it out because I want you to invest in it. I'm pointing it out because the situation is getting worse over there, but this doesn't seem to affect our markets. Whereas just the hint of financial troubles from one, albeit very large, developer over in China, started making our markets pull back. So the lesson here is news media, right? If the news media wanted to, that's news as of last night, if they wanted to, and they started focusing on Chinese real estate problems again, that would pull our markets back. But it already is an issue. So just because it becomes on TV, you will make the emotional decision to go ahead and sell and say, that's it, world's over, it was going great, no holiday rally, we're done. Please be very careful with how the news media can choose to focus on a topic which now you know what's going on. So if this comes up in the next couple days, watch what happens, and you'll be like, now we're scared? We weren't scared before. What's the deal? It's all in how it's framed. Okay, so some stocks in the news here, and we'll get on our way. Amazon, they're buying some more space in Florida. We have lots of big Amazon buildings here. They're looking for 50,000 square feet in Miami, and imagine what that costs. Anyways, PG&E, remember these guys? They're working on it. They're trying to recover here. PG&E has reinstated their dividend. It's a penny a share. I just thought it was funny. It's a penny a share, so maybe you like that. Pinduoduo beats earnings by a mile. Had a great earnings report if you're interested in looking at that sort of thing. They did great. I didn't spend a whole lot of time on it, but that was in the news. Twilio got a big day today, 3.5% there. Always mess this up. Anson Capital it basically has bought a big chunk of this company here, and they're pushing for them to be sold, which ultimately could take them private depending on which direction they go. And so that's in the news. Other than that, some of the real estate stocks, Crown Castle, we happen to own this one. Nice to see a little bit of a rally there. Real estate in general just had a great day today. Tomorrow, and I'll take your questions if you have any questions, but in the meantime, we'll say tomorrow, retailers. Remember, earnings season is basically over, but the retailers will continue to report. Foot Locker, Dollar Tree, I think Salesforce is in there somewhere. Five Below, I know Salesforce, not a retailer, but pointing that out. Five Below, Lazy Boys. Five Below, by the way, was the one of only one of only 3 retailers that opened up at 6 p.m. on Thanksgiving. So will that, it won't show up in this earnings report, but will that translate into guidance that we can look at? What else do you got? Hormel Foods, Patterson Energy, a couple of little smaller guys reporting as well. Crude oil inventories will come out tomorrow. You have the beige book as well, so that always is a focus and likely an afternoon temporary market mover there. And then it's kind of conference season for the healthcare people. Just for the smaller ones, like Evercore has a healthcare conference. And so there could be some news in the healthcare space. You go, well, why did one of these stocks have a big move? It was probably something that had to do with that conference. The same sector conferences at Piper as well. So it just could be, if you notice some healthcare nonsense there, that's more than likely what's happening. You'll probably see a quote or somebody doing something there with one of their comments, expectations, analysts, whatever it is. Dustin says, I got to throw in all my money in small caps. I'm not saying, I can't tell you what to do, but, you know, I could just say, like, for God's sakes, chasing the large caps. And I get this stuff because more and more clients will be like, should we get rid of these and go all in large caps? Or, hey, why didn't you tell me we should go more in large caps? I'm like, no, we shouldn't. I would have. I'm not saying it because I don't want you to do it. For most people there. Kirk says, after Roth IRA, your extra money goes into high yield savings accounts. More of a statement, less a question, but good job. Good job. I hope high yield hopefully means more than 5% still, because that is available out there. Arbitrage available, opportunity on Hess? No. All in small caps, yeah. You think going back to record highs there you go. Oh, MW saying, no, I'm already in all in small caps. I see what you're saying. I love it. Also, I got done just a little bit ago with a sort of a webinar thing with Goldman Sachs regarding structured notes and alternative investments, things that normally the very, very wealthy get to participate in. You won't freaking believe some of the stuff that people get access to just because they have a lot more money. No longer going to be the case. We are integrating that into what we do. So the average person, if they want a structured note on a losing position that they have and limit their downside and play along on the upside there, even lever the upside without taking any more risk and not having any costs. Fascinating that now, I knew this was all available, but typically it was like a manual process. One by one, you'd have to go and offer this to people. Now we're able to do it at scale. Fascinating. Super fascinating. I love it. All right, a couple more questions and we'll get on our way here. Tom, opinion on Morgan Stanley adding to your position. You like the pullback there. Yeah, I can't blame you for anything. So this is where your risk is at. Just keep in mind, these types of stocks that did not participate with the market, they are technically underperforming. And even though they've rallied, they are pulling back already. Double whammy, right? So there's a little more risk there. We say this is a stock that otherwise is not performing in most ways with the stock market. Is it an opportunity, or do I need to allow for more, maybe a wider stop loss if you do that sort of thing? You got to recognize that and say, I'm not going to go all in because I can't have a really tight stop. I may need to, the markets fell and now Morgan Stanley, which was already weak, started falling as well. May need to leave a little room for that. But I don't blame you for looking at those types of stocks now. Does it matter Russell 2000 versus S&P 600? Historically, the S&P 600 does perform better if you're looking at an index. I'm just using the Russell 2000 futures just because they're right here. But you can use a proxy like IWM or whatever your favorite one is. Hey, it's cold there too. I don't want to hear it, man. I have one sweater. This is my sweater. Kevin gave me one sweater. This is all I got. If it's cold tomorrow, this will be 3 days in a row with a sweater. I don't know what I'm going to do. I don't know. It's almost 50 degrees outside. Yeah. And cloudy too. So it's not even like a nice sunny one. But yeah, what is this? Small cap underperform. Small caps do underperform if you're talking about compared to the S&P 600. Absolutely. More volatile too. You got to be willing to like some of that volatility. All right. Hope you learned something today. Hope I steered you away, right, from making silly decisions here. And we'll be back tomorrow to do it all over again. Thank you for watching. Thanks for supporting. And yeah, adios.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.